Every rupee or dollar in your wallet has a story. From the moment it's created by banks or printed by the government, money travels through countless hands, businesses, banks, governments, and individuals, fueling trade, investment, and growth. Along the way, it influences jobs, prices, and even the value of other currencies. Understanding how a single unit of money moves through the economy reveals the hidden forces shaping your financial life. In this video, we'll trace the journey of 1 Rs or $1 and uncover how money truly flows around the world. Today, we will talk about the journey of 1 Rs/$1, how money moves in the economy. So before we start, make sure to hit the like button and subscribe to my channel. 1. The journey of 1 Rs/$1. Have you ever wondered what happens to a single rupee or dollar after it enters the economy? Every coin and note, or digital unit, travels through a complex network of banks, businesses, and consumers. Money is not static, it is constantly in motion. When you spend 1 Rs at a shop or online, it becomes someone else's income. That person may deposit it in a bank, which then lends it out to another borrower, and the cycle continues. This movement creates economic activity, jobs, and growth. Understanding the journey of just one unit of currency reveals how interconnected our financial system is. Even small amounts, when multiplied across millions of transactions, drive national economies. By following the path of money, you can see how spending, lending, and investment affect everyday life, inflation, and wealth distribution. Each rupee or dollar is more than currency. It is a tool shaping economic behavior. 2. How banks play a key role. Banks are the main hubs where money's journey accelerates. When someone deposits 1 Rs or $1, the bank doesn't just store it. Through fractional reserve banking, the bank can lend out a portion while keeping a small reserve. This loan creates new money, effectively multiplying the original unit. That same 1 Rs might now represent multiple deposits, loans, and transactions across the economy. Businesses borrow to expand, consumers borrow to spend, and governments borrow to invest. Each step circulates money, making the economy dynamic. Banks earn interest on loans, which incentivizes them to keep money moving. Central banks influence the pace with interest rates and regulations, but the commercial banks are the engines driving circulation. Understanding this shows how a single unit of money is amplified to fuel commerce, employment, and growth across sectors. 3. Spending and respending. When you spend 1 Rs or $1, it doesn't disappear, it continues its journey. The shopkeeper receives it and may use it to pay employees, suppliers, or bills. Those recipients then spend it again, creating a chain reaction. Economists call this the multiplier effect, where a single unit of money generates multiple rounds of spending. This effect is crucial for economic growth because each transaction supports other businesses and households. Governments also participate. Taxes collected from spending fund public services and projects. The same 1 Rs circulates multiple times before eventually being saved or repaid. Following this path reveals that money is not just a static medium of exchange. It is a powerful driver of activity, influencing demand, production, and prices throughout the economy. 4. Loans and money creation. Banks accelerate the journey of money by lending. When a bank issues a loan, it creates a deposit, adding new money to the economy. This is how a single 1 Rs or $1 can effectively expand into several times its original value through lending and spending. Mortgages, business loans, and personal loans all contribute to this process. As borrowers spend the loaned money, it reaches other accounts and banks can lend again. This continuous cycle of creation, spending, and redepositing keeps the economy moving. Without bank lending, money would remain largely static, and economic growth would slow. Observing the journey of money through loans reveals the hidden engine of modern economies, credit-based circulation. It also highlights why interest rates and lending policies have a massive impact on growth, inflation, and everyday financial decisions. 5. Interest, the cost of movement. Interest is the fuel that keeps money moving. When a bank lends 1 Rs or $1, borrowers pay back more than they received. This additional amount, interest, compensates banks for risk and encourages them to lend again. Interest also drives economic activity because borrowers must earn money to repay loans, generating production, investment, and employment. At the same time, interest affects how fast money circulates. Higher interest slows borrowing and spending, while lower rates encourage activity. Without interest, banks would lack the incentive to create money through lending. By understanding the role of interest in the journey of money, we see how the system balances growth, stability, and profitability, ensuring that currency continues its journey through the economy rather than remaining idle. 6. The role of consumers and businesses. Consumers and businesses are the main travelers of money. Consumers spend money on goods and services, while businesses pay wages, invest in operations, and purchase supplies. Each transaction sends money to new hands, keeping it in motion. Businesses also borrow, invest, and expand, creating new opportunities for money to circulate. Every rupee or dollar contributes to a network of payments that connect households, companies, and governments. Economic health depends on the smooth flow of money. If consumers stop spending or businesses stop investing, circulation slows, reducing income and growth. By understanding the roles of these participants, we see how each individual and organization contributes to the journey of every unit of currency and the overall economy. 7. Digital money and the modern economy. Most money today is digital. Cash accounts for only a small portion of the total money supply, while the rest exists as bank deposits and electronic transactions. Digital systems allow money to travel instantly between accounts across cities and countries. This speed amplifies the journey of every rupee or dollar, making economic activity more efficient and interconnected. Online payments, mobile wallets, and digital transfers ensure that money keeps circulating with minimal friction. However, digital systems also require trust, regulation, and cybersecurity. The path of a single digital unit can now extend globally, influencing trade, investment, and economic policies. Observing the digital journey of money highlights the interconnectedness of modern economies and how technology accelerates financial flows. 8. Inflation and money velocity. Inflation and money velocity are closely linked to money's journey. Money that circulates quickly, high velocity, stimulates demand and production. If spending grows faster than supply, prices rise, causing inflation. Conversely, slow circulation can lead to economic stagnation. Central banks monitor velocity and adjust interest rates to maintain balance. A single $1 or $1 has more impact if it changes hands frequently. Tracking money's movement explains why monetary policy matters. By influencing spending, lending, and saving, authorities can stabilize prices and support growth. Understanding these concepts clarifies why inflation occurs even when we personally hold the same amount of money in our accounts. 9. Governments and fiscal policy. Governments influence money's journey through taxes, spending, and borrowing. When governments collect taxes, they remove money from circulation temporarily. When they spend on infrastructure, salaries, or subsidies, money re-enters the economy, often with a multiplier effect. Borrowing from banks adds another layer, injecting more currency into circulation. Fiscal policies shape the path of money by influencing demand, production, and employment. Observing how government decisions redirect the journey of a single rupee or dollar illustrates the hidden levers that control economic growth, public welfare, and financial stability. Money is not just personal, it is a tool for shaping society. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.